Rishi, help us with the outlook for the Indian markets because GST reset that has happened, implementation from today is the whole trade war, and what happens to the India-US trade deal is something that the markets are watching out for. What's the sentiment that you are gathering for the Indian markets as of now?
Yes, thanks. So Indian markets, as we've all seen over the last year, has been difficult, initially coming down, then recovering, but there being a lot of volatility. But it seems to me from all angles, fundamental, macro, technical cycles, a lot of quants that we do, obviously, all combined that the worst seems to be over. Having said that, there is still going to be some more volatility and uncertainty for the next 1 or 2 quarters, but I think in phases, things should start getting better. Obviously, the reason for the last 1 year to not be easy has been about, overextended valuations, earnings growth also not coming in over the last few quarters, and, the overall macro and geopolitical uncertainty globally. A lot of that still continues, but from a lot of angles seems to be in the last phases. So, as those things start clearing up, I think, we'll start seeing markets headed higher. Overall, my view at a broader personal level is that, like I said, the next 1 or 2 quarters, you could still see some volatility, but the nearer term breakdown, if I do, then, overall slight uptrend from now itself is the way I would look at it. But there could be some volatility from now till Diwali. From Diwali to New Year, an uptrend. There is some seasonality usually, which also supports that. And as further numbers start coming, I think that will also help. And then again, some uncertainty, some volatility in Jan to March period. But post that quarter, I expect that, the longer term uptrend of the market should start picking up again.
Okay, Rishi, hi, morning. So that's your sectoral, that's your near-term outlook coming in on the market right now. But you did speak about overextended valuations. Now, given the way the market has been correcting largely and been in a tight range for so many months now, do you believe that some of the sectors that were very heavily valued earlier, they now start to look attractive? And on the back of that, have you been doing or are you considering any rejig in the portfolio?
Yes. So see, for us, we are fully systematic, as you may know. So obviously, we run a lot of models which combine, fundamental, traditional data and alternative data. So there's a lot of signals, obviously, that come in from the fundamental data on value, quality, sentiment, etc. But there's a lot of alternative data which gives us a faster, measures and faster signals. And therefore, you can actually rebalance at shorter intervals also. So there's a lot of stuff we do which is very different from the markets and therefore, it's more like while there is a longer term view embedded, but it is a mix of a lot of short term views. So there's a lot of short term rebalancing that keeps happening, which leads to that, longer term sort of outlook. So from that perspective, what is immediately showing up, for example, we also have a sector rotation model. So, what shows there, and that can obviously change on a monthly or a quarterly basis. But for now, of course, autos are looking interesting from that angle. So both model and of course GST, tailwind is there. That is looking good. PSU banks, so overall banks are looking slightly better, but within that PSU banks are looking even better than most private banks. And then telecom and retail are slightly looking better. And selective metals as well. What is not looking that great is FMCG. So despite some excitement post the GST on FMCG, it still doesn't look as interesting as many other sectors, and from a price action perspective seems to be faltering. So both combined fundamental and technical and quant, it doesn't look as interesting as originally people were thinking. And IT is obviously the difficult one, right? I mean, it's underperformed in the last 6-9 months. A lot of news flow coming into it, including, over the weekend. Looks that this current H1B news would not impact too much for most of the companies. And even for those that do, it will be minimal only. But having said that, there's been too much news and too much talk even around the AI impacting it. Growth has anyway been sluggish in that sector last few years. So, that is going to be the difficult sector. But just from a, price action perspective, it does look overextended on the downside. So, while our models would typically avoid or, underweight such a sector, it could be possible that some of those things start, playing out much better. So there could be some reversals in selective pockets in that segment. So from that angle, it is interesting. But if someone wants to take a longer term view and, get into it post all clarity, then obviously one should still avoid it till more clarity emerges.
All right, that's about the sector preferences right now. But along with that, Rishi, amidst this market, you're also coming out with a new fund, and that's a flexi cap fund launch that will happen. Help us understand, how is this fund going to be different versus what we already get to see in the markets? What sort of a risk management will be at play here?
Sure, happy to. So this is going to be a very different fund from what is out there in the market. It is in the flexi cap category. So obviously NSE 500 is the benchmark, but it is a purely systematic process, what we call SAE, which is systematic active equity. BlackRock does have a global division called SAE, systematic active equity.
Okay, we've snapped that line. Let's move on. And Rishi, once again, thanks so much for taking us through what your near-term market outlook is and the sectoral preference as well. But while we're talking about the GST theme, let's talk about a sector of beneficiaries, and that is cement. Among all the other sectors, you also have cement that